Welcome to the Deep Dive. We take a massive topic, grab a whole stack of fascinating sources, and really boil it down to what you need to know. Today, we're plunging into the incredible and often pretty turbulent world of cryptocurrencies. I mean, it started as this obscure, almost niche experiment, didn't it? And now, crypto's exploded. It's a global market projected to top, get this, $2.5 trillion by May 2025. That's just staggering. It's not just big. It signals a really fundamental kind of seismic shift in global finance.
It really does. And, this incredible growth, it's created this huge dilemma for governments everywhere. On one side, you've got the clear potential, the allure of things like financial inclusion, maybe lower costs for sending money home, remittances, and just this powerful engine for innovation. But then flip the coin, and there are these really deep-seated fears keeping policymakers awake. We're talking money laundering, tax evasion, worries about funding terrorism, systemic volatility that could shake economies, and even, the fear that central banks might lose their traditional grip on monetary control.
Exactly. And that tension, that's what we're here to unpack today. We're going to explore how governments are scrambling, really, to bridge this gap, a gap between this super fast-moving technology constantly disrupting, constantly innovating, and these legal frameworks that, let's face it, were mostly built for a 20th century financial system.
Right. It's like trying to fit a square peg in a round hole sometimes.
Totally. So to do this, we've got a great stack of sources, academic papers, global economic reports, including some key insights from the BIS and Chainalysis. We've also got specific case studies, policy recommendations. We'll look closely at how this is playing out in places like Latin America and also in the OECD countries. We'll identify the big challenges, look at some proposed ways to sort of harmonize innovation with financial stability, and crucially, what does it all mean for you? Okay, let's get into it. We mentioned the scale, but maybe ground us a bit more. Just how big is this crypto market really? And what are the specific fears that keep coming up for governments? What's the data saying?
Yeah, the numbers are pretty compelling when you look closely. The Bank for International Settlements, the BIS, they estimated back in 2024 that already 1.5% of global GDP is stored in crypto assets. Now, 1.5% globally, that's significant. But here's where it gets really interesting. That figure jumps to over 10% in countries that are dealing with chronic depreciation of their own local currency.
Wow, 10%. So it's not just a tech bro thing anymore.
Not at all. It's becoming a substantive part of the global economy, especially, where traditional financial systems might be seen as less stable or accessible. It's filling a need, or at least perceived need.
Okay, and that brings us to the elephant in the room for a lot of policymakers, the illicit activity. Is it as widespread as maybe the headlines sometimes suggest, or is that narrative a bit overblown?
That's a really critical question. And the data, it paints, let's say, a nuanced picture. Chainalysis, they put out data for 2024, looking back at 2023. They found that 0.34%, less than 0.5% of all on-chain crypto volume was linked to illicit activities.
Okay, 0.34%. I mean, any is bad, but that percentage sounds, well, maybe smaller than some might expect.
It might seem relatively small in the grand scheme, yes. However, and this is the crucial part, that percentage spikes quite dramatically. It jumps up to 1.9% when you specifically isolate transactions involving what are called mixers. These are services designed to obscure the transaction trail, and importantly, they often aren't obligated to follow Know Your Customer or KYC rules.
Ah, right, the anonymizing services.
Exactly. So that distinction, it really highlights where the regulatory challenge lies, doesn't it? It points to a clear vulnerability for financial authorities trying to get visibility. So while it's not the vast majority of transactions, there are these specific pockets that definitely demand focused regulatory attention.
Okay, so that makes sense. It's not everywhere, but there are hotspots. So given all this, the scale, the illicit use concerns, what does it mean for policy? Does government action, does regulation actually move the needle on crypto's value? Or is the market just too wild and decentralized?
Oh, it absolutely matters. Quite profoundly, actually. There's research, Auer and Klessens back in 2018, they showed this pretty clearly, announcements of outright prohibition. They found those could knock Bitcoin prices down by between 8% and 18%. Significant drops.
Right, so bad news has a real impact.
Definitely. And conversely, just the expectation of favorable regulation, maybe hints that rules might become clearer or more supportive, that could actually boost prices by up to 12%. So it clearly shows the market isn't operating in a vacuum. It reacts, and reacts strongly to regulatory signals, both positive and negative. Policy decisions have real, tangible consequences for how crypto is valued. It tells us that regulators can steer the ship even if it's a very fast-moving one.
Okay, so governments aren't just watching from the sidelines. They're actively trying to different strategies to, well, get a handle on this whole thing. What are the main kinds of regulatory models we're seeing pop up around the world? What are the different flavors of regulation?
Yeah, we can sort of group them into a few broad categories, each with its own, pros and cons. First, you've got what you might call absolute prohibition. We've seen this in places like China, Bolivia. Now, does it stop crypto use entirely? Well, it certainly decreases the local visible volume, but what often happens is the activity just gets displaced. It moves to offshore exchanges or peer-to-peer networks.
Ah, so you don't eliminate it, you push it out of sight.
Exactly. Which arguably could make it harder to monitor and control. It reduces the supervisory visibility for the domestic authorities. You end up creating a kind of shadow market rather than actually getting rid of the activity. It's like squeezing a balloon, it just bulges out somewhere else.
Right, okay. That makes sense. Pushing it underground isn't necessarily safer. So what about approaches that try to sort of embrace the tech but control it?
Precisely. That leads us to the idea of controlled sandboxes. Colombia's Aranera project is a good example. Chile and Brazil are also exploring similar things. The idea here is to allow new financial technologies, including crypto-related ones, to be tested, but under direct regulatory supervision in a contained environment.
Like a safe space for financial experiment.
Kind of, yeah. And the early signs from these sandboxes are actually quite promising. Preliminary evidence suggests something like a 22% drop in fraud complaints compared to similar platforms operating completely outside the regulatory net. So it offers this potential middle ground. You can foster innovation, let new ideas develop, but build in oversight and learning right from the start.
Okay, a 22% drop in fraud, that's definitely noteworthy. It sounds good for testing, but does it scale up? Does it really address the whole market's need for regulation, or just manage a small piece? Are there other ways governments are trying to fully integrate this stuff, not just test it?
Yeah, good question. That brings us to another major approach, licensing models. Think of the BitLicense framework in New York in the US, or regulations we're seeing in places like Morocco. This approach sets up formal licensing requirements for crypto businesses wanting to operate legally. But a key feature is that it often significantly elevates the cost of entry. We're talking potentially $100,000, maybe even up to $500,000 just to get licensed.
Wow, that's a high bar.
It is. And while the intention is clearly good, ensuring compliance, protecting consumers, maintaining financial stability, it can have unintended consequences. It can inadvertently lead to market concentration. Fewer larger companies might be able to afford the license and the ongoing compliance costs.
Right, squeezing out the smaller players.
Potentially, yes. And while having fewer larger licensed firms might seem easier to supervise, it could also create new systemic risks. If one of these big licensed players fails, the ripple effects could be much larger. It's kind of the classic too big to fail problem, but manifesting in the digital asset space.
Huh. That's a familiar regulatory headache, isn't it?
Right.
Doesn't matter if it's old banks or new crypto firms. Okay, so we've got prohibition, sandboxes, licensing. Is there another main way governments are thinking about this, another core approach?
There is one more main philosophical approach, which is commodity classification. We see this particularly in places like Switzerland, Liechtenstein. This approach tends to favor the tokenization of real-world assets. So think about representing things like real estate or gold or even art as digital tokens on a blockchain.
Making physical stuff digitally tradable.
Exactly. It's a very innovative use of the technology, turning tangible value into something liquid and easily exchanged digitally. But this approach heavily relies on having really robust infrastructure for custody who holds the underlying asset safely, and it needs very clear rules about how existing capital market regulations, the rules we already have for stocks and bonds, should apply to these new digital asset types. So this path often tries to integrate crypto by defining it within familiar legal or financial categories like a commodity.
Okay, so looking across all these strategies, prohibition, sandboxes, licensing, treating it like a commodity, what really stands out to you? It feels like there's definitely no single right answer, no silver bullet here. Each one seems to have its own trade-offs.
Yeah, I think what's fascinating is that diversity, but also a couple of recurring themes. One is that outright prohibition, while maybe politically tempting sometimes, it rarely seems to achieve the goal of actually controlling or eliminating the activity. Like we said, it often just creates new risks that are harder to see and harder to manage.
Right, the underground economy problem.
Exactly. And the sandbox approach seems to be gaining some traction precisely because it tries to acknowledge the innovation, the potential benefits, while building in that safety net, that learning phase. But the fundamental challenge for all these approaches really is how do you adapt regulatory regulatory thinking that was developed for national centralized systems. How do you adapt that to something that is inherently global, often decentralized, and moves incredibly fast? That's the ongoing puzzle, the continuous learning curve for regulators worldwide.
Let's pivot a bit and focus on Latin America. It's a region with its own unique set of economic challenges, and maybe because of that, it's become this fascinating real-world laboratory for crypto adoption and regulation. What can we learn from the experiments happening there?
Latin America is absolutely a compelling place to watch right now for both the ambition and sometimes the friction in implementation. Take El Salvador. Obviously, they made huge headlines adopting Bitcoin as legal tender back in 2021. A world first.
A very bold move. How's that playing out on the ground?
Well, it's complicated. Surveys done by Universidad Francisco Gavidia in 2024, they paint a really nuanced picture. They found that while a majority, 52% of the population, trusts the president who pushed the measure, they actually disapprove of the Bitcoin law itself. And maybe more tellingly, only about 14% of small businesses were actively accepting Bitcoin.
Only 14%. That's
Yeah.
quite low, considering it's legal tender.
It is low. And it raises this really important question about top-down mandates versus grassroots adoption. Can you force the use of a new technology like this? Or does it need to grow more organically? It suggests a real gap between the policy ambition and the practical reality for everyday people and businesses. You know, it's almost like you can lead a horse to digital water, but making it click accept Bitcoin is another story entirely.
Interesting. So, a bold experiment, but maybe not the runaway success hoped for, at least not yet in terms of widespread use. What about the flip side, where ambitious regulation maybe hits roadblocks?
That's a good description of what happened in Panama. They had this initiative, Project Law 203, started back in 2020. The goal was to regulate stablecoins, regulate crypto exchanges, seemed quite forward-thinking. But fast forward to August 2025, and the law still hadn't actually been approved. It stalled.
Why the holdup?
It seems to reflect pretty strong resistance, particularly from Panama's very powerful offshore financial sector. That sector has, traditionally benefited from a more hands-off regulatory approach. So it really highlights how entrenched interests, existing economic structures, can put the brakes on regulatory progress, even when the stated goal is to modernize and bring things into a clearer framework. It's a classic political tug of war.
Ah, the power of established players. That's a familiar story in finance, isn't it? But it's not all stalled progress or mixed results, right? Are there examples where a country seems to have found a more successful path?
Indeed. Mexico actually offers a much more proactive and, you could argue, more successful approach so far. They implemented a comprehensive fintech law back in 2018, and under that law, their National Banking and Securities Commission, the CNBV, set up regulations requiring crypto operators, exchanges, wallet providers, etc., to get a specific license. They're called financial technology institutions.
Okay, so a clear licensing framework. Did it work?
Well, the numbers suggest it's had a significant impact. Between 2020 and 2024, Mexico granted 47 of these authorizations, and critically, during that period, they successfully captured or tracked about $1.2 billion worth of tokenized remittances coming into the country through these licensed platforms.
$1.2 billion in remittances. That's substantial.
It really is, and it demonstrates a potentially promising path, doesn't it? It shows how you can leverage crypto's potential advantages, like maybe lower costs or faster speeds for sending money home, which is vital for millions of developing economies, but you do it within a regulated structure that builds trust and provides oversight.
So, looking at El Salvador's bold move, Panama's stall, and Mexico's seemingly more pragmatic success, what's the big takeaway here for other developing economies, especially those looking at crypto for things like remittances or boosting financial inclusion? It sounds like being proactive and thoughtful beats either just banning it or going all in without a clear plan.
I think that's exactly right. What's really fascinating is that Mexico's example suggests that if you design a clear, well-structured regulatory framework, one that provides oversight and builds trust, but doesn't completely stifle the underlying innovation, then crypto can potentially be harnessed for significant economic benefits, especially in areas like remittances that are so crucial for development. It really points towards needing a tailored approach, not just a generic one-size-fits-all regulation, but something designed for the specific needs and context of the country or region. It raises that key question. How can these lessons be shared and adapted effectively elsewhere?
Right. So beyond these national experiments, governments and international bodies aren't just reacting anymore, are they? They're actively developing new tools, new instruments to shape the future. What are some of these emerging tools that could really change the game for crypto regulation going forward? pushing towards a more stable, integrated future.
Yeah, we're definitely seeing a shift towards more proactive, forward-thinking approaches now. It's not just about playing catch-up. One huge area is central bank digital currencies, or CBDCs, and related concepts like hybrid blockchains. You've got projects like Brazil's Drex, which is in its pilot phase in 2024, and the Digital Euro project in Europe, maybe looking at 2027-28 rollout. What are these really about? Fundamentally, they seem aimed at competing directly with private stablecoins, the dollar-pegged tokens issued by companies.
So the central banks want their own digital cash to compete.
Essentially, yes. If you connect it to the bigger picture, it's about preserving central bank monetary control in a digital age. It's about ensuring national digital sovereignty, maintaining financial stability, and making sure there isn't a vacuum filled entirely by private, potentially less regulated digital money. They want to offer a public digital currency option.
That makes sense. Keeping control in national hands while offering digital benefits. But what about tools for watching the existing crypto market, the one that's already out there, operating globally?
Right, that's where RegTech on-chain solutions come in. RegTech just means regulatory technology. These are basically sophisticated forensic analysis tools. Companies like CipherTrace, Elliptic, they develop these. What they allow supervisors, central banks, financial regulators to do is monitor critical things directly on the blockchain. Things like liquidity risk at exchanges or how much exposure traditional banks might have to crypto assets. And they can do this almost in real time.
Real-time monitoring. That sounds like a big step up from waiting for quarterly reports.
It's a huge step up. It dramatically improves oversight capabilities. You move beyond slower, traditional reporting methods to a much more dynamic, data-driven approach. Regulators can literally see patterns and risks emerging on the blockchain itself. That's a potential game changer for transparency and managing risk proactively, not reactively.
Okay, so better national digital currencies, better monitoring tools. But crypto is global. What about coordination between countries, especially for things like preventing tax dodging across borders?
That's arguably the most significant development on the horizon. The Crypto Asset Reporting Framework, or FEARF. This is approved by the OECD, the Organization for Economic Cooperation and Development, back in 2023. And it's scheduled to actually go into effect globally starting in 2027.
CARF. Okay, what does it do?
It's designed to be a monumental step towards global tax transparency for crypto. Essentially, it will require crypto exchanges, no matter where they are based, to automatically collect and share information about their users' crypto transactions with the user's home country tax authorities. So if you're resident in country A, but use an exchange based in country B, that exchange will have to report your activity back to country A's tax office automatically.
Wow, automatic global sharing of crypto tax info. That sounds like it could really clamp down on tax evasion using crypto.
That's precisely the goal. It aims to combat tax evasion on a global scale by ensuring transactions get reported to the right tax jurisdiction, leveling the playing field with traditional financial assets. This initiative, CARF, along with the push for CBDCs and better RegTech, it really signifies a growing international consensus. A consensus that the crypto world needs greater accountability, more transparency, and needs to operate under rules that are more aligned with the traditional financial system.
So reflecting on everything we've discussed, this deep dive really shows a fascinating evolution, doesn't it? Governments seem to be moving away from that simple ban it or let it run wild approach. Instead, it feels like we're heading towards what you might call proportionate regulation, trying to differentiate between different types of crypto assets.
Exactly. Differentiating between, say, highly volatile, decentralized coins like Bitcoin versus asset-backed stable coins versus maybe tokens representing real-world value, they all carry the same risks or offer the same potential.
And we've seen that just trying to ban it, pure prohibition, it doesn't really eliminate the risk, does it? Just pushes it elsewhere, maybe makes it harder to see.
Precisely. It displaces it rather than solving it. And this convergence we're seeing now towards things like interoperable CBDCs, combined with this automatic tax information exchange under CARF, that's going to significantly reduce the ability for exchanges or users to operate completely in the shadows. It forces a higher degree of transparency and accountability.
And crucially, it seems like the aim is to do this while still trying to preserve the potential upsides of the underlying blockchain technology. Things like speed, efficiency, lower transaction costs.
That seems to be the balancing act, yes. And for regions like Latin America, thinking about that remittances angle again, Something like a regional regulatory passport, allowing licensed firms to operate more easily across borders within the region, could be really powerful for inclusion. Provided, of course, that those underlying governance gaps, the issues with enforcement and oversight we talked about, are also addressed effectively. It's not just about the rules on paper, but how they work in practice.
Right. It's about building genuine trust and efficiency, not just control. So this really leaves you, our listener, with a fascinating, maybe quite tricky question to think about. Looking ahead, maybe one of the biggest challenges isn't just technical or regulatory, but socio-political. How do we as a society effectively educate the public? Educate people about the very real risks involved in crypto, the volatility, the scams, without completely stifling the innovation that makes the space so dynamic. And related to that, how do we combat that widespread perception, that sometimes simplistic view, that all cryptocurrencies are just elaborate Ponzi schemes? That perception can really overshadow the legitimate uses and the genuine technological advancements happening. So thinking about all that, what stands out to you? What do you see as the single most critical hurdle we need to overcome for crypto to truly integrate safely, effectively, and sustainably into our global financial systems? Something to ponder.